Yeah, welcome back. We are going to continue to talk about business taxation and about a special topic, namely the taxation when you sell shares in a corporation. And naturally, as we talk just about the corporation tax system, a warning must be issued, or a warning must be made. This naturally is only about shares in a corporation, so about entities where corporation tax is due. This does not refer to shares in a partnership, which you said. That's a question for far, far later. Well, okay, we are here, Chapter 5, Corporation Tax System, and the first thing is selling shares. And in this small video chapter, we talk about selling shares by natural persons. You know or you remember that in the German tax system, the legislator follows a kind of guideline when it designs the tax rules, which say, which says, when you sell shares or give them away in any other way, that should be dealt with according to the same rules as if you had kept them and received the dividends. So there should be a parallel treatment. So let's just remember how dividends can be treated in case of a natural person. There are two ways. First, if they are classified as income from capital, then usually they are taxed with a flat rate of 25% on all the dividends. That could be found in 32D1 ESTG. And in cases where the dividend belongs to any other type of income, most cases income from business, for example, if shares are held for a business reason by another business, then the dividends would also end up as income from business under section or paragraph 15 ESDG, and then they would be taxed as what you can remember as the 60-40 rule. That means 40% of the dividend income was left tax-free. That is paragraph 3, number 40 ESDG. So these are the basic rules, and now the gain from the alienation of such shares, so from selling them, could be treated as follows. If the gains are classified as income from capital, then the dividends would be treated with a 25% tax rate, and so it's not so great surprise that when a gain is classified as income from capital, that is the case when you have a very, very small percentage of shares in a company. Then you end up in the category income from capital, paragraph 20, section 2 ESTG, and you will get taxed with 25% on the gain. So same tax rate, flat rate on the gains from capital as in cases where you give or where you get dividends. Now, in cases where the gain belongs to a different type of income, mainly to income from business, there the 60-40 rule will again apply. So 40% of the gain will be tax-free, 3 number 40. This case is mostly given in two constellations. The first one is if the shares are held in a business property. Then you know business property will always be taxable when it is sold. So irrespective of the percentage of your participation, from a single share to 100% of all shares, in all cases, the selling will be taxable under paragraph 15 with no peculiarities. Or if your shares are private property, so if you do not hold them for business purposes, if you are a mere shareholder, do not have that investment within another business of yours, it's private property, then you remember there is a special rule if you have had at least 1% or more in a company during a single moment during the last 5 years before you sold them, then the sale will be classified as gain from business, as income from business, under a specific rule, paragraph 17.1 ESTG. And so it will be classified as notional income from business. So the rules for income from business will then be applied, 60/40 rule. If you, by the way, take a closer look in cases of that paragraph 17 ESTG, especially the parallelism between the dividends and the treatment of the gains is a bit broken, because in such a case, although the shares are private property, at the moment only when they are sold, they will be reclassified as business income, with the consequence that the 60/40 rule applies, so that 40% are left tax-free and the 60% will be taxed under your individual tax rate. Whereas during the time when the dividends flowed in, when you held the participation, the current dividends were always classified as regular income from capital and were treated with the 25% flat rate. That does not always, that shows that not always a fully parallel treatment exists, although formally you still have the parallel treatment here, because if it's income from business, and that is fictionally the case in cases of paragraph 17, but only at the moment of sale, then the 60/40 rule applies. By the way, there are even cases where somebody who holds such a major participation can opt for the regular taxation of the dividends. Also, when the dividends flow in, then you would have again a full parallelism, because then the dividends would be taxed under the 60/40 rule, and the later sale of the paragraph 17 participation would be taxed in the same way. But this is rather a special case. So concentrate on the general outline of the rules. By the way, just to give you the full information or to remind you of everything, naturally, or at least from the perspective of German tax law, naturally, when revenue is privileged, is tax-free, then also the expense must be treated correspondingly. So under the 60/40 rule, if 40% of the revenue or 40% of the gain are tax-free, then also 40% of the expense are non-deductible. So only 60% of the cost and the book value can be offset against the gain. That is paragraph 3c, section 2 ESTG. You should probably already know that. In case of the 25% flat rate rule, usually expense cannot be offset at all. That is due to the simplification idea behind that 25% flat rate. The idea was we wanted to spare all these dividend recipients the efforts to hand in a tax declaration, and if expense had been deductible, then naturally a tax declaration would have been necessary to check if the expense can really be acknowledged and verified. And so the simplification effect here forbade that. Yeah. So there is a last aspect to clarify. Not always you have only dividends, because in the beginning, at least when you found a company, you also have to make contributions. And so the question is, how will they be treated when you sell shares or when you get them paid back? Usually the contributions are treated as historical costs of the shares, so they increase the book value of the shares. So they lower the gain which you made. And if the amount of the contribution is paid back later by the company, this amount will not be treated as a dividend, but as a payback of historical costs. So if you receive a payback of a contribution during the time when you hold the shares, that will not classify as income. It just lowers the book value of your shares as a payback of historical costs. Okay, so now let's think a bit about the economic background. Why does it make sense to treat someone who makes gains from the sale of a share in the same way as someone who collects the dividend over time? You need to think about that because there are sometimes fiscal officers or other people in the outside world who say it's an enormous privilege that people who sell shares don't have to pay taxes on their full gain, whereas others, for example, if you sell a house within the first 10 years, you have to pay the full income tax rate. That's an injustice, an unfairness in favor of the capital investors, in favor of the rich. And so you have to think about the reasons. Otherwise, you will probably not be able to sleep silently and comfortably during the next nights, because then the world would be fundamentally unfair, and that should not leave you with a good sleep. Well, so let's think about the economic background of selling shares. The first question is naturally, how much would you be willing, if you want to be fair but not an idiot? How much would you be willing to pay for a share? Let's simplify matters, not for 1%, but for 100% in a corporation, if that corporation is going to make a profit of 100,000 euro. And let's assume there is no uncertainty. We do not want to complicate life more than it needs to be complicated. So, how much would you be willing to pay for 100,000 future profit? Well, your first answer is probably, if you neglect the time effect and the interest effects, your first answer is probably 100,000. Congratulations, you evidently are a really fair person. But this first answer of yours is fundamentally wrong, because well, that leads us to the why. What was our mistake? Well, imagine you are going to spend 100,000 for an investment. If you do not want to make a loss, that means you need to get at least 100,000 back, otherwise you are an idiot. Now, how can you get back money from investing in shares? Well, if we do not think of a Ponzi scheme where everybody, or a snowball system, as it is called in Germany, where everybody sells to somebody else and it has no fundamental value, then there is only one way how you can recover your money in form of dividends, which the company is going to distribute. Now, only dividends can pay off your investment. Okay. Now, if the company expects profits of 100,000, they cannot distribute that money to you without paying corporation tax. Now, if they pay corporation tax, let's say 20%, then out of 100,000, they can only pay out 80,000. And so you can now check your initial calculation. You paid 100,000. The maximum you can get back, relying on your data by which you calculated your price, is 80,000. So a loss of 20,000 is guaranteed. And that brings you to the fundamental conclusion. Probably the two of us, you and I, are not the first people on earth who detected that defect. You can assume, on the other hand, or in the opposite, that probably every rational, reasonable buyer throughout the world who intends to buy shares knows about this fundamental misconception. So they will just adjust their behavior. They know if a company is going to make a profit of 100,000, the maximum amount which I can pay for it is the 100,000 minus the corporation tax. And that is a compelling conclusion. let's fix it. And that is something which you never, 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 ever need to forget. Now you can say, but if we, let's say, hide the profits in the corporation and never disclose them, so never realize them, we always keep them in form of hidden reserves, but then the corporation tax doesn't happen. And then the answer is, but then you never get the money out of the corporation and get it back into your hands. So you can only recover the money if it's distributed to you in form of dividends, and it cannot be distributed to you in form of dividends before you disclose it, realize it under the commercial accounting rules, and so before you have paid corporation tax on it. There is no way out. So just paying 500 million for an investment without deducting the deferred tax liabilities is the most fundamental mistake which you can ever make. Good. So the maximum amount which a rational buyer can ever pay for the shares of a capital company, if he or she is willing to be fair, is not the amount of all future expected profit, but the amount of the future expected profits minus corporation tax. And that leads to a following price formula. The price for shares is 1 minus the rate of corporation tax, or if there is again also a trade tax on top, minus corporation tax plus trade tax. So RC is the rate of the condensed rate of all income taxes to be paid by the corporation, times the sum of all expected profits for all the future periods which are expected still to come. And you can then you can even say, well, if I want to take the time aspect into consideration, you can even sharpen the formula by saying, okay, the price which I'm going to pay is 1 minus RC times the discounted expected future profits. But that does not change the fundamental statement that you always lower all the future profits by the corporation tax rate. You do not pay the full nominal amount. So the way how a rational buyer determines the price for a share always implies that the seller is indirectly, via the price process, the price mechanism, or via the market process, charged indirectly with the corporation tax. So we have already once a tax burden, although hidden in the price process. Now, what would happen if the vendor of these shares would then still be charged with the full regular income tax rate on the gain? Well, let's calculate that first based on the assumption that the cost of acquisition for the shares was 0. In that case, what remains? Then we had a gain of in full amount of the price, and we would have 1 minus RC minus the discounted expected future profits until the end of eternity, and that would then be taxed with the regular income tax rate. And so we would have the future profits completely taxed twice. You would have a full economic double taxation. The corporation tax rate would fully be applied, and then the full income tax rate would be applied. We have the same double taxation constellation, which we also would have in case of dividends. And in case of dividends, we said that is too much. Nobody would ever choose that way if we have two full taxes, so we must grant relief. And if we have here the same economic situation as in the case of dividends reception, we should draw the same consequences. Otherwise, it's a bit unreasonable what we do. And if we were to behave in an unreasonable way and say, well, we just say only in case of dividends we mitigate economic double taxation, then we would have to say, okay, what would our shareholder then be able to receive in case that he or she renounces on selling the shares? In that case, they would collect the dividends over time, and so they would have a present value of their property, discounted expected future profits times corporation tax rate. That would be the amount of the present value of all dividends which are to come if you hold this share till the end of eternity and never sell. And then all the dividends would be taxed with the reduced income tax rate, for example, with the flat rate of 25% instead of your personal rate of 45. So in that case, you would have a far higher present value of that alternative. So in that case, people would say, my present value of my property is far higher if I keep the shares. Now, what if you need money? Um, Simple. You would not sell the shares. You would say, I go to a bank, I show them my shares. We agree on what is the expected amount of future dividends. They give me a credit. I keep my shares. And with the dividends, which are to come year by year, I pay off the interest and the payback amounts of the credit. This way, I can obtain a higher present property, a higher wealth today, and it's risk-free. It's a clear situation. So in that case, when you do not establish a parallel economic outcome of the two alternatives, you just create a stock market where nobody ever sells shares, and the whole thing is fundamentally unfair because two economically identical situations are treated differently. For this, you would have to bring forward very, very convincing reasons. Why should somebody who sells a share have a higher economic capacity than somebody who keeps the share and realizes the same amount of money in form of a credit? That is not to be explained. That can't be explained in a convincing way. So you would distort the market, you would act unfairly, and so the outcome or the conclusion is you should treat these two situations alike under the same rules in the corporation tax system. So the idea is evidently if you apply a flat rate to dividends, you should also apply a flat rate to the gains. And if you just say we grant a relief that only 60% of the dividends are taxable, then also 60% of the gains should also be taxable. Now the question is, I demonstrated this up to now based on a formula where I only took into account or where I had a cost of acquisition of 0. Is my basic logic still convincing if I also take into account the fact that there were cost of acquisitions in the beginning? So if you do not deal with the founder of a company, but a subsequent buyer of the shares who is then going to sell. Here, let's differentiate between the first holder of the shares and the others. Let's begin with the first holder of shares. That person has a book value, a cost of acquisition amounting, or which corresponds to the contribution which was made into the corporation in the beginning. Let's say 100,000 in the beginning is your contribution, 200,000 is the expected future profit. In that case, the price which you could obtain when you sell it would be 1 minus the corporation tax rate times all the future profits, and you could recover the amount of your contributions, because if you had contributed 100,000 euro in the beginning and that money is still inside the corporation, the buyer would have to compensate you for that amount too. So you would get 100,000 plus the 200,000 minus corporation tax rate. So your if you are the first buyer or the first holder of the shares, the founder of the corporation, your book value would be the amount of the contribution. You would receive 200,000 minus corporation tax rate plus the 100,000 in cash. And so your profit would be 1 minus corporation tax rate times the profits plus the contribution minus your book value, so minus the contribution. So what remains is 1 minus corporation tax rate times the future profits. And here you see you will be compensated for the dividends. So that shows if you treat at least the first holder according to that rule, 60-40, or 25% on all the dividends, 25% on all the gains, that indeed shows then you have a parallel outcome, then everything's fine, that seems to work. Now let this second buyer of the shares again try to sell to a third buyer. Then the gain is again the new price minus the old price, which our buyer or present holder paid. Our present holder paid at the point of time N, well, the contributions or retained earnings even. So all the amounts which need not to be taxed anymore, let's say the 100,000 contributions, and then all the expected future profits in the future, because they still have to be taxed. Well, so let's say all the expected future profits from Tn to T eternity. That was what you paid when you bought the shares. And now when you later try to sell the shares to somebody else, then that somebody else would also look to all the future profits and would compensate you for the amount of contributions which is still locked in the corporation. And if there are retained earnings which have already been taxed, they would also be compensated. But we leave them out of consideration here. Well, in that case, the gain would be the second price minus the first price. And so that would be 1 minus the corporation tax rate multiplied with the expected future profits, the difference in the expected future profit between the two periods of time. So again, subjecting this gain to the same income tax rate as the dividends, if they flow to that shareholder in the future, would lead to exactly the same economic result as if that person collects the dividends. So if you want to do something against economic double taxation in case of dividend reception, you should be consequent and apply the same system in the case of selling the shares. Otherwise, you would once mitigate economic double taxation, and in the other situation where it is a bit more hidden, you would leave it unchanged, and that would be very unfair, very strange, and it would distort the market completely. So that is what I wanted to show you. And please remember for all times until the end of eternity how the price, the reasonable, rational price for a share is calculated. That you do not pay for all the expected future profits, but only for the expected future profits after tax. Then you can understand all the economic effects and rules which apply to selling shares. And you have seen here, if you then try to bring that into the form of some formulas, then even that works. Okay, that shall be sufficient for today. Thanks for watching. Thanks for listening. Would be nice if you remember the important details here, and would even be nicer if you come back to the channel. If you recommend that channel to the one or other person whom you like, or whom you don't like, depends on the situation. And that was enough for today. Thanks for watching. Till later.